We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin. And with me for today's Wallet Watch segment is Brian Williams from Northshire Consulting. Welcome, Brian.
Hey, Eric, happy to be here.
Yeah, Lord knows there's no shortage of things going on that are going to affect our listeners' wallets. We had inflation, both consumer price index and producer price index come in high. We've had a historically high interest rate hike, and we've had some really interesting things going on in the world of crypto. So why don't we start with the crypto? We've seen what's the equivalent of a major crash.
Yeah, that's pretty significant. I mean, following the one that is most popular that people are familiar with is Bitcoin. So we closed out the year. I mean, the highs November, December around that 66,000 mark, and it actually hit over the weekend about 17,600 as it converts to dollars. And as we record this, we're a little bit over 20,000. So it's interesting that I was talking to my wife and she was like, well, isn't it closed over the weekend, or isn't it, you think of it in terms of the regular market, but no, it's always trading. So it can trade Saturday, Sunday, so all the way through. But it did have some real intensified selling over the weekend, and I don't want to say it's necessarily stabilized now, but people like round numbers in our business. So it's back above that 20,000 mark. One thing that's interesting that sort of carries over, I think, to normal investors and just people with regular brokerage accounts or savings accounts is the idea of having a run on the bank where you think of maybe It's a Wonderful Life or something like that,
Right.
when the movies where people are lining up and they think the bank's going to go under, so they want to get their money first. So people are concerned about that on the crypto market and how that could spill over into the broader economy. And so what happens sometimes is, a long time ago in the banking world and now in the crypto world, is you have some of these exchanges basically freezing accounts, saying there's too much volatility right now. You can't get your assets, you can't get your money out of the accounts. So if you could just help us out here, we're going to freeze your accounts for like a week, and hopefully everything's stabilized and then it's back to business as usual. So that's definitely not what people are used to. But that, the good and the bad of crypto is that it's not regulated. So it doesn't have those same sort of protections on the downside like an FDIC insurance or SIPC or something like that on the brokerage side. So that's always a concern, is that even though if people don't own any sort of crypto or Bitcoin directly, that this could spill over into the broader economy and affect other brokerages. And if people can't get their money from crypto, then they may have to sell stocks if they're in a position where they need income. So does this precipitate the market sell-off that we've experienced? So that's what we're keeping an eye on, is not necessarily just the crypto markets, but how it spills over into the broader economy.
Right. Now, over the weekend, a number of pundits speculated that the crypto crash would actually have a very minor effect on non-crypto owners and the markets as a whole, because unlike other forms of currency, the vast majority of people don't use cryptocurrency to actually pay for things. And unlike commodities, which have an intrinsic value other than trading, there's no intrinsic value in crypto.
That's right. Yeah. And that's normally what people think, is these things are sort of isolated and contained. But if you remember early on in the financial crisis of '07 and '08, Ben Bernanke kind of famously said, we've looked into this and we understand it's a concern, but it's not going to have any impact on the broader economy or something, as I'm paraphrasing there. So When you get into derivatives, and if a larger bank has loaned money or invested in one of these crypto platforms, and we just don't know what we don't know at this point. And I hope you're right, and I hope it doesn't spill over. But if you think of the people who are typically invested in this, it's a lot of young folks. It's a lot of people who got involved in during the pandemic as they were home, and that type of stuff. So how does this affect them long term? And maybe it gets to the point where they're just uncomfortable with investing in general, and it leaves a bad taste in their mouth. And maybe you've got a group of individuals who decide not to save for retirement and things like that because they had such a bad experience with this. So all those sort of fallouts from this could be a concern.
And you're speaking of younger investors, we're also at the point where they are seeing their first bear market. As the markets dropped definitively into bear territory last week.
Yeah, that's right. So bear market is defined as down 20% off the peak. So we hit that on the S&P 500, and the last significant down year we had was 2008. So you're talking about 14 years where we've had any significant downturn like this that's lasted this long. A little bit right around the early pandemic, but everything shot back up so quickly, and people were so focused on other things. I feel like people kind of slept through that in a way. But yeah, I mean, if you've got somebody who started their career in 2005 or something, they certainly lived through that crisis, but they didn't maybe have a lot invested. And now you're 17 years later, and that 23-year-old starting their career is now 40, and now they've had a decent account balance, and now it's when they see it in real dollars and they get that statement, and it's 15% lower than it was before, and it's real dollars to folks. A couple $100,000 in a 401k, and now it's down $30,000 in 3 months. So that matters to people. And even though they might know what the right thing is to do is just to continue on that path and know that it turns around. It's emotionally it can be pretty taxing, especially when the losses, people come up with these weird things in their head like, geez, I've worked for 6 months into this year, and I've lost everything that I've made, as far as an income goes. I'm basically flat for the year. And people run those type of calculations, and it's different. Yeah, you have to teach them that bear markets are just part of life and part of their retirement planning process. And just the fact that we haven't had one for so long, it doesn't change the way people view it. They're still going to be emotional about it, and they're still going to be kind of upset about it, even the pure analytical.
I think on the contrary, for folks that haven't seen a bear market before, it's actually going to make them more emotional and more nervous because they haven't lived through it before.
Right. Yeah, that's what I'm saying. And you've got a lot of people who are very analytical, and they might say, well, we're down. This is just part of the, trying to separate the math from the emotion of seeing that on your statement is difficult, even for the most analytical folks. But most of the numbers out from the 401k trading platforms and stuff don't show that there's been a lot of trading activity, which is a good thing. There's been a lot of changes in the market since 07, 08, the proliferation of target date funds and in models and type of things that are put together. So people didn't just necessarily pick out their own funds like they used to do 15 years ago. So most people are on a path and less likely to trade out of that. So all the trading numbers are not as high as they were during that period. So that's all a good thing.
Right. And for those people who feel they do need to rebalance their portfolios, there are still sectors that are doing well. We've talked about this in the past. The energy sector is still doing well. So there are bright points even in this volatility.
Yeah, absolutely. I mean, energy was sort of that last bastion of area of the market that was doing well, even though it got beat up over the last week, down about 17%. But it's still up year to date, up over 34%. So that is the one sector that's had some silver lining year to date.
So for those people who are starting to get emotional and getting nervous about not just the markets, but the economy in general, how do you recommend they handle getting their emotions in check?
Well, it really is a tough challenge, but I would say look at it, trust the process sort of thing. I mean, understand that what's worked well for them the last, 10 or 15 years will continue to work well. Don't make any radical changes, because remember, if you getting out of the market is one thing, but you also have to hit it right going back in, so you really have to be right on two different occasions, which is very tough. It's hard to even be right on one occasion. So if you sell out of the market and you go into cash, you might sleep a little bit better at night, but you want to stay invested, because normally when these markets go through a severe downturn, the snapback is very quick, and some of those large up days, if you miss out on them, it could really hamper your, put a damper on your retirement projections and things like that. So just trust the process, stay invested. I mean, make sure you're allocated appropriately. It's always a good time to take a look at your investments and make sure they're aligned with other people your age and how you should be invested. But just don't make any dramatic moves. And think about your contributions that are going in each paycheck. You're buying lower than you did before. So if you're upset about the prices at the grocery store going up, well, think of the stock market as the other way. Say, well, at least I'm buying shares of those cereal companies at a lower cost than I did a year ago. So try to think about it that way, as stocks are on sale, and that's the one area that's actually not had huge run up in price. So you try to think about it that way. Think of the reverse of the grocery store, right, or the gas station.
Exactly. Yeah, I
If you heard a
remember.
gas station was on, giving away gas at $2 a gallon right now, you'd be lining up around the block to get it. So think of the same thing with the market.
Exactly. I remember when I was learning finance, I was told trying to time the market is like trying to catch a falling knife.
Right.
And it's true. You're better off just staying steady rather than, freaking out and trying to hit that perfect moment.
Yeah, and there's a ton of those little sayings, be greedy when others are fearful, which would be right now, and be fearful when others are greedy, that type of stuff. And your returns are based on time in the market, not necessarily timing of the market. So it's just simple math equation. The more time you spend in the market, the better your numbers will be.
Exactly. And that's the raw naked truth. Thanks for being with us this week, Brian.
Thank you.
And you can catch every episode of The Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.